Have you ever read The Big Short, or maybe watched the movie? If so, then you've already met Jamie Mai and Charlie Ledley, the main characters of this story. You see, in The Big Short, they were featured for their trade during the 2007-2008 financial crisis, where they turned a $1 million bet against the housing market into over $80 million. However, we'll save that story for another day. Instead, this video will focus on one of the firm's earliest trades involving Capital One stock. A trade that, as you will soon learn, netted Cornwall a roughly 2,000% return in a little over 1 year. So sit back, relax, and enjoy the ride. I'm Nick, and this is Great Trades Revisited. Jamie Mai sets up the backstory for this trade in his interview for the book Hedge Fund Market Wizards. In that book, he describes the following scenario. In 2002, Capital One stock dropped from $50 to $30 in one day after the company announced that it had reached an agreement with regulators to sharply increase its reserves against its subprime-laden loan portfolio and to improve its credit risk assessment procedures. You see, the previous storyline had been that Capital One's long string of strong earnings was driven by its superior quantitative models for assessing subprime credit risk. Now the question became whether Capital One's financials were more a product of fraudulent accounting than better risk modeling. This led to disagreement and controversy among professionals, with some analysts claiming that the company was a fraud and other analysts saying that the management team was totally above board and top-notch. The odds that the stock would still be near $30 in 2 years seemed vanishingly small. Either the company would be vindicated or it would go under. Mai and Ledley proceeded to research the company intensely. One of the main areas of focus was on management, since the essential questions about Capital One related to the ethical character of management. A key source in this story was the chief risk officer of Capital One, who was largely ignored by other people. Over time, Mai and Ledley came to the conclusion that this chief risk officer seemed honest and did not sound like someone trying to spin a story. Through their discussions with management, their analysis of certain line items related to the company's profitability, and additional research, Mai and Ledley decided to put on a bullish position. But then the question became, how should they express their view? Again, Mai gives us some insight in his interview for the book Hedge Fund Market Wizards, when he states the following. We thought buying the out-of-the-money call options provided the best way to express the trade, because the potential bimodal outcome made a large price move much likelier than usual for the stock. Under these circumstances, the out-of-the-money calls were most mispriced and had more embedded leverage. We were looking at buying the January 2005 $40 calls, which were trading near $5. Then there was some marginal bearish news, and the stock traded down to about $27. The calls we were looking to buy went down from $5 to $3.50. That was a big percentage move, which made the juice in the trade look much greater, and we bought the calls. For those of you out there who are a little unfamiliar, here's a quick side note about options. Options are contracts sold by one party to another that give the option buyer the right to buy or sell a stock at an agreed upon price within a certain period of time. In other words, the option contract has a definitive end date. In the scenario expressed by Mai, the January 2005 $40 call options refer to the call options that expire in January 2005. These options would be worthless if the stock traded at less than $40 a share at that time. However, the options would be said to have intrinsic value if Capital One stock were trading above $40 a share at that time. And as you can see, $40 in this case refers to the price of the stock. However, the option has a unique price as well, which changes when the stock price changes. Again, in the scenario expressed by Mai, the call options cost $3.50 when Cornwall bought them. One last thing to note is that options are always priced to represent 100 shares of stock. So, with the Capital One call options trading at $3.50, it would cost the purchaser $350 to buy one call option. Now back to the story. So how many calls did Mai and Ledley buy? Well, in total, they purchased about $26,000 worth of out-of-the-money call options. And for Mai and Ledley, this story had a very happy ending. Over a year later, Capital One stock had fully recovered when they were vindicated by the regulators, and the Cornwall team cashed in their initial $26,000 investment for over $500,000. The highly asymmetric trade had paid off and paved the way for future successes at Cornwall. I want to thank everyone who made it through this video, and if you would like to learn more, I've included some links down in the description. And, as always, liking and subscribing are never expected, but always appreciated. Take care, and I'll see you in the next video.